But that's what I want to see. I want to see silver above 30, and I want to see the ratio below 70 for us to really know that we are well on our way. And again, I think that will happen probably by the end of this year. Uh, these markets tend to accelerate as they get stronger, and hopefully not over accelerate, although they could, ebb and flow again, move up really fast, and then get a big smash. And then people that bought it at 28 and watch it go up to kiss 29 and change, and then bang, it's back down to 26 in a week. Get disheartened. Oh my goodness, I never should have bought. I knew 28 was the top, and blah, 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 blah. Talk themselves out of it. Maybe get out of the market. And then the market all of a sudden, 2 months later, is back at 30, and it gets over 30 and it stays there.
Good evening, esteemed investors. Tonight, we bring you an in-depth update from David Morgan, a leading expert in precious metals. David shares a bold outlook, suggesting that silver could potentially surge to an astonishing $2,000 in the coming weeks. Let us explore the factors behind this potential rally and what it could mean for your investment portfolio. David begins by highlighting a key development in the gold market. Recently, the $2,000 level in United States dollars has shifted from a point of resistance to a firm support level, marking a critical turning point for gold's upward momentum. This breakthrough indicates a strong bullish trajectory for gold, which has naturally drawn the attention of silver investors eager to understand how this will affect silver's price. According to David, several fundamental drivers are at play in the silver market. One of the primary catalysts has been large-scale investments from European funds, which have begun acquiring physical silver in substantial quantities. These investments have spurred movement in the silver market, with demand growing steadily alongside a notable supply deficit. As David points out, this demand is underpinned by strong fundamentals, particularly within industries like solar energy, which now accounts for nearly 30% of total silver consumption. This consistent demand, combined with limited above-ground stockpiles, creates a favorable environment for silver prices to advance.
That gold had broken out, and the $2,000 US dollar marker became support rather than resistance. So gold is obviously making the next leg up, and how long it'll go, and where it will get to, and how long, we don't know. But we do know that it's taking place. So that just continued to, manifest. And so the silver people were like, well, what's going on? And so somewhere along the line, some buddies decided to get in the silver market. And on the physical side is actually some European funds that took some pretty healthy amounts of silver in physical form and moved it into their fund. And that, I think, was the impetus to start to see the price move. The other part, of course, has been the fundamentals have been strong for well over a year, where we're seeing a supply deficit, which I'm waiting to see if the next silver reports from, Metals Focus at the Silver Institute and then CPM Group, and see what Matt Watson has to say about it. But those three studies, I'm anxious to see if the above ground stockpile is diminished or not. I believe it has, which means there truly is a deficit going on. And solar is just such a huge amount of offtake now, where it's almost 30% of the market, at least by some analysis, it's that big. And, you take 30% of any market, that's significant. So that's, I think, what brought it. It hasn't really been retail. Retail at this time has kind of been sitting on the sidelines. There are a lot of people that are new to the silver market that invested physically and paid very high premiums, even for like silver rounds. And now some of that's been sold back to the dealers or the wholesalers, and they're sitting on inventory. And the markups have been, or the premiums have been, discounted or changed significantly to be very much smaller than they were a few, months ago, where they were much higher. So it's kind of a difficult market to analyze from. Price keeps going higher, but the retail side's flush with inventory. What's taking place, and it's basically institutional support and futures trading. I would say every major currency except the dollar. I think if we get to, I don't know what it would be, because I don't look at the foreign exchange markets that often, but We get it in all the other currencies you mentioned, new highs, all-time highs. I don't think it'd have a lot of effect on the market. I mean, it would in that jurisdiction, but when you see those all-time highs, many people, retail investors, are not going to say, oh, it's an all-time high, I'm going to sell my silver now for fiat. Most of those people are looking for even higher prices, and they're looking to, hold for higher prices. And the new buyers, as I mentioned a minute ago, are the institutions, and they really don't care what the price is. That sounds rather stupid, but it's actually the truth. Because in most instances, it's price inelastic to an institution. Now, not an institution that's buying for price appreciation, like a hedge fund. Shouldn't have said institution. Let me take that back or walk that back. Institutions are looking in the futures markets or ETFs for price appreciation. Industrial users is what I meant to say. Industrial users are price inelastic, so they don't really care that much. So if they have to buy silver at $30 or $35 to put, a tenth of an ounce into their product, it really doesn't affect the cost of that product. That's price inelastic. If it's only 0.1% of the product and becomes 0.2% of the product, they don't care if the price doubles. And that's the case for silver in so many instances, be it, automobiles, be it something, even solar panels. It's not as big a percentage of the cost of a solar panel as people might think. So it's price inelastic. Like these industrial users really, do they care? Yes, somewhat, but it's an insignificant change for them, which is very beneficial to the silver market as a whole, because they could come in and see the solar industry, double from what it was a few years back. And yet, since it's price insensitive, it's not safe for these solar companies to say, oh, I got to cut back on the amount of solar panels. Silver costs me too much. No, it's full steam ahead. Keep going, baby. Pump these panels out. On the institutional side, that's different. But they do it basically with the futures markets, not with physical. There's some funds that do buy physical. And when you look at the biggest one, the SLV, it makes no sense, because the silver price is going on a tear, and yet you see a depletion of the silver coming out of the SLV. Now that ebbs and flows, and I know there's been, some pretty massive amounts of silver put back into the SLV. But on aggregate, on the whole, basically where you would see silver now with all new time highs in most currencies, you would see a larger input into the silver SLV, and it would be above and beyond where it's ever been before. And it's not. It's much lower than where it's been before. So that begs the question, what's really going on? And I think the answer to that is that these silver commercial bars that are needed for industry are being taken out of the market and used in the industry. And therefore, you've seen the SLV ebb and flow, as I said, but basically the offtake is there. Same thing with the COMEX registered category. Same thing with the LBM.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Vance. David emphasizes the resilience of industrial demand for silver, which remains relatively unaffected by price fluctuations. Unlike retail investors, industrial users of silver, such as automakers and manufacturers in the solar panel industry, view silver as essential, regardless of minor price hikes. This characteristic, known as price inelasticity, means that industrial buyers will continue to purchase silver even if prices rise, as its cost represents only a fraction of their production expenses. For example, a rise in silver's price may have little impact on the cost of a solar panel, as silver only constitutes a small percentage of the panel's overall cost. This steady industrial demand bolsters silver's market strength and provides a strong foundation for future price increases. In addition to industrial demand, David also discusses the impact of institutional interest on silver prices. While retail demand for silver has fluctuated, with some investors selling back to dealers, institutions have increasingly entered the silver market with a focus on long-term value rather than short-term price movements. This institutional support is evident in futures trading and investments in exchange-traded funds, adding a layer of stability to the market and reinforcing a positive outlook for silver. Another point David addresses is the dynamic between silver prices and the inventory levels of popular silver exchange-traded funds, such as the iShares Silver Trust. Despite rising silver...
Gold is on its way to 2,000 support, and it'll be the same thing with silver at 30. So we hit that round number and get through it and become support, which I said in the January issue, I thought we'd get to 30 this year. And whether or not it becomes support or not, I don't know. I didn't know in January. I still don't know. But the way things are going, it looks like that will happen this year. I don't think it's going to be immediate. Could fall off 28. I'm looking actually for an indicator to provide me for calling an intermediate top, and that's always tough to do, especially if you're wrong, especially for people that pay you for your insights. But I see the other whites are coming up today. Platinum and palladium are both making 3.5% moves in a day. Usually when they come and are laggards, they're lagging. Silver's lagging gold. The other white metals are lagging silver. When they catch up, so when I see $1,000 platinum or thereabouts, that will probably be the intermediate top. So I'm giving away some of my insights. Doesn't mean I'm right, so take it with a grain of salt, folks, but that's what I'm looking for. The one so far it's already hit in this bull market was 33 to 1. So it didn't get to 30 to 1. So I would say under 40, you would want to probably switch from silver into gold. I wouldn't do it all, but people do what they do. I would take half of my trading position because it could get to 20 to 1 once we really get going here. But I thought you were going to ask me a different question on when do you think, what ratio do you need for the gold-silver ratio to be for you to be convinced that silver is going to make its move, and that's 70 to 1. And we're not there yet. 7 to 1 on 70 to 1 on silver at 30, 7 times 3 is 21. So 70 to 1 ratio, gold would only be at 2,100. And we're at 23 plus change right now, 23.30.
Silver prices. The inventory of the iShares Silver Trust has not increased proportionally, indicating that significant quantities of physical silver are being directed elsewhere, most likely toward industrial uses. This discrepancy suggests that the demand for physical silver is robust, especially in sectors like electronics, automotive, and solar energy, where silver plays a critical role. David highlights the psychological impact of round numbers in commodities trading, noting how silver's potential move past $30 could create a similar effect to gold's recent rise above $2,000. Just as gold's breakthrough at $2,000 signaled a shift in market sentiment, silver's breach of the $30 level could mark the beginning of a new phase for the metal. David points out that if silver surpasses $30 and holds this level as a support, it could spark a psychological shift among investors, paving the way for further price appreciation. Furthermore, David delves into the significance of the gold-to-silver ratio, a critical metric in precious metals investing. He suggests that a ratio below 70, combined with silver prices above $30, could signal a robust bull market for silver. Currently, this ratio remains just above that threshold, but David believes that with further momentum in silver, it may soon drop, strengthening the bullish case. Finally, David advises investors on navigating the inherent volatility in precious metals markets. He explains that while sharp price swings may dishearten some investors, this volatility is part and parcel of the journey toward substantial long-term gains. In his view, staying the course during these turbulent times is crucial for those seeking to benefit from the full potential of silver's upward trajectory. In summary, David Morgan urges silver investors to recognize the robust fundamentals supporting the metal's price. With industrial and institutional demand remaining strong, coupled with a significant supply deficit and a psychological threshold approaching, silver's future looks promising. Stay tuned for more updates on the precious metals market.